In the previous video, we learned what GHG accounting is, why companies measure greenhouse gas emissions, and understood Scope 1, Scope 2, Scope 3, global warming potential, and carbon dioxide equivalent. But many beginners still have one question. How does a company actually measure all of this? Do they calculate carbon emissions directly? No, not at all. Companies follow a structured process. Think of it as a recipe. If you skip one step, your final carbon footprint will be inaccurate. Today, I'll walk you through the exact 5-step workflow followed by organizations before they report emissions. Once you understand this process, you will never look at GHG accounting the same way again. Why a process is needed. Imagine your company asks you tomorrow, calculate our carbon footprint. Where would you begin? Would you immediately start multiplying numbers? Of course not. Before any calculation happens, you first need to understand the business. This is one of the biggest misconceptions about beginners. GHG accounting is not about calculations. It is about understanding operations. Calculations comes much later. Let's see how sustainability professionals actually approach this. Step 1. Identify the activity. The first question is not how much carbon. The first question is what activities are happening inside this organization. Every organization performs hundreds of activities every day. Electricity is consumed, fuel is burnt, employees travel, raw materials arrive, products are transported, waste is generated. All these activities may create greenhouse gas emissions. Notice something important. At this stage, we are not calculating emissions. We are simply preparing a complete inventory of activities. Think of this as making a shopping list before cooking. If an activity is missed here, its emissions will never counted later. Next, step 2. Identify the source. Now that we know the activities, the next question is, where are these emissions coming from? This is where Scope 1, Scope 2 and Scope 3 become useful. For every activity, ask, is it coming directly from the company? Then it's Scope 1. Is it caused by purchased electricity? Then it's Scope 2. Is it happening somewhere else in the value chain like suppliers, transport, employee commuting or product disposal? Then it's Scope 3. Think of this step as sorting your expenses into different folders before preparing your financial statement. The activities remain the same, only the category changes. Step 3. Collect activity data. Only now do we start collecting numbers. Notice something interesting. We are still not measuring carbon. We are collecting activity data. For example, how many kilowatt hours of electricity were used, how many liters of diesel were consumed, how many kilograms of waste were generated, how many kilometers were traveled. All these are called activity data because they describe what actually happened inside the organization. Good data is the foundation of good GHG accounting, whereas poor data leads to poor decisions. Step 4. Convert data into emissions. Now comes the part most people think is GHG accounting, the calculation. But calculations are actually only one step in the process. The formula is simple. Activity data into emission factor is equal to greenhouse gas emissions. For example, if a company consumes 1000 liters of diesel, that activity data is multiplied by an emission factor that tells us how much greenhouse gas is released per liter. If different gases are produced, they are converted into carbon dioxide equivalent using global warming potential values. This allows us to compare all greenhouse gases using one common unit. Step 5. Turn data into decisions. This is where real sustainability begins. Many people think GHG accounting ends with a report. It does not. The report is just the beginning. Now the organization asks which activity produces the highest emissions. Where should we reduce emissions first? Should we switch to renewable electricity? Can we improve fuel efficiency? Can we redesign transportation routes? Can suppliers reduce emissions? GHG accounting is not done to create spreadsheets. It is done to make better business decisions. That's why carbon accounting has become a strategic business tool, not just an environmental exercise. If you remember only one thing from today's video, remember this workflow: activity, source, data, calculation, and decisions. Every carbon footprint, every ESG report, every BRSR disclosure, every net zero strategy begins with these 5 steps. In the next video, we will move a level deeper. We will actually calculate emissions together using simple real-world examples. You will learn where emission factors come from, how carbon dioxide equivalent is calculated, and how companies estimate their Scope 1, Scope 2, and Scope 3 emissions in practice. If you are serious about building a career in ESG, sustainability, or carbon accounting, don't skip the video, because understanding the process is important, but knowing how to apply it is what makes you valuable. For more such insights, join our free sustainability and ESG community. Do like and share the video to the one who is like you waiting for clarity. I'll see you in the next video. Thank you.